Hello, everybody. Welcome back to Untangling Climate Finance, which is brought to you by Gordian Knot Strategies. I'm the host, Jay Tipton. I'm going to kick off this episode with another listener review that was left for us on Apple Podcasts. This one comes from Lenny DeGrom and says, "This pod takes a challenging and complex subject matter and breaks it down in a very engaging, understandable way. Jay is able to connect with some extremely knowledgeable and qualified guests and meet them where they're at, offering a new element to the climate finance puzzle with each episode. After hearing one more recent episode for the first time, I went back to get the full context of what they're doing and really enjoyed the journey. Keep up the great work." Well, Lenny DeGrom, very much appreciated. We always appreciate when listeners leave a review, so thanks for that. Okay, I'm going to keep this episode introduction short because the podcast conversation does most of the talking for itself. In this episode, I invited our CEO, Sean Penrith, back on the pod to discuss climate finance, carbon markets, impact investing, and biodiversity credits. We cover a lot of ground on these topics, so I want to jump right into it. Sean is a 20-year climate finance expert and an absolute wizard in all of these spaces. So without a doubt, you're in for an excellent episode. Let's go. Hey, Sean, welcome back to the show.
Thank you.
So you were our first guest, which was actually about a year ago when we launched the podcast, and you outlined the concept of what climate finance is for our audience. Clearly, a lot has changed since a year ago, since our first conversation. So I thought it would be good for you and I to connect again to chat about the major areas of work that we focus on at Gordian, which are climate finance, carbon markets, and impact investing. So I'd like to start with climate finance. And we've had this conversation numerous times that there's no universal agreed upon definition of what climate finance is. So can you, as you interpret it, provide a brief definition of climate finance?
Sure. Thanks, Jay. Yeah, I would describe it as referring to the financial resources, the various financial instruments that we use to support all actions addressing the mitigation of climate change. And so this includes funding for both mitigation, so the reducing and the avoidance of greenhouse gas emissions, and of course adaptation, which is enhancing our resilience and adaptation efforts to meet these changing climate impacts.
Great. Thank you for that. And so we read a lot of reports that outline the simple fact that the world is falling extremely short on climate finance, the climate finance that we need to mitigate and adapt versus the actual amounts of climate finance that is being unlocked and used. And that amount that we're falling short is in the orders of trillions annually. What is holding us back?
Yeah, that's a good question. I think in all the work we engage in with clients from around the world, in short, if you ask them what's holding them back, it is the lack of investable product. And what does that actually mean? It comes down to, well, first let's put it in context. I mean, we have to increase financial flows, climate finance flows, at least threefold if we're to achieve the targets that we set out under the Paris Agreement in 2015. So when you look at the lack of investable product from the investor's point of view, it is a very difficult endeavor for these impact investors, despite how willing they are in wanting to explore the field of impacting both for financial returns and for environmental impact, because we have limited data, we have limited analytical tools, we have limited frameworks for assessing both the risks and opportunities. And this sort of opaqueness, if you will, in being able to evaluate these opportunities is problematic because it can lead impact investors to essentially make the wrong call, misallocate funds, which affects the performance of those investments, which informs other would-be investors that there's potentially a problem. And so it reduces the confidence and the willingness in the field to put capital to work in such an
And so what do you think that we can do to change that?
Yeah, I mean, clearly, like Impact investing, the same as ESG and carbon accounting, the same sort of Achilles heel is what needs to be changed. And that is that we need to improve the levels of transparency, accountability, standardized frameworks for reporting, clear metrics. I mean, if you talk to an impact investor about a project in Australia and an impact investor in Zurich that invests in the global south, there is no harmonized vernacular or metrics or frameworks which allow them to talk about the same project in the same way. And so this really limits the amount of trust and the accountability and the monitoring efforts that we can place in these projects. The other thing we need to change is if we want to mobilize private capital, and we know that if we're to meet, I'll just take the nature-based sector for a second, we need to mobilize $8.1 trillion a year by 2050, using the opportunities or the potential in the natural climate solution space. Now, 60 to 70% of that capital must come from the private sector. That is a lot of capital. And for that capital to be mobilized, it must go to the right projects, i.e. projects and opportunities that work. Now, when you talk to private investors that are venturing or foraying into the world of impact investing, the number one thing that comes up in every conversation is what is the level of risk? What is the balance between the projected returns and the exposure, the risk they will face? And so what do we need to do to change? We need risk mitigation instruments, in short. That's clearly what we need. We need guarantees, things like insurance, blended finance models, credit enhancement, the things that we can put in place which allow these impact investors to move confidently, not without risk. I'm not saying remove risk, but at least mitigate the level of risk that they need to feel confident in moving forward. The other thing is really is establishing favorable incentives. We have a lot of tax incentives for many, many different industries like oil and gas. Unfortunately, we don't have the same type of incentive structure for impact investing or climate finance. You know, if you look at the ratio of tax subsidies in the US, it's about a 16-to-1 ratio. So 16 times more of the tax subsidy support goes to oil and gas as an extractive industry versus what goes to the climate finance or the impact investing sector. So seriously out of kilter. We need to change the incentive structure to help advance the field.
So you just listed a handful of pretty significant topics that we need to address: risk, transparency. In this space, are you seeing any bright spots that are addressing that? And generally, are there any bright spots in the past year since we've spoken in climate finance?
Well, yeah, I mean, we can't ignore the fact that there has been a massive increase in engagement from the private sector. Impact investors cannot ignore the role that ESG, environmental, social, and governance efforts, and the push from the corporate aspect to reach net zero targets or transitions. There is this wave of companies around the world committing to sustainability goals, which by virtue of that offers up an impact investing opportunity. So the bright spots are we're seeing increased engagement from the private sector. We're also seeing support from the regulators in terms of disclosure. As we know, the Security and Exchange Commission put a proposal on disclosure. The European Union has got all sorts of disclosure requirements that are coming to the fore. And so we see positive movement, I would say. We're also seeing the emergence of pretty innovative financial instruments. We're seeing the utilization of green bonds, of course, the carbon credit market, blended finance solutions. I mean, I remember when I led the Climate Trust back in Portland, Oregon, we launched Climate Trust Capital, which at the time was a very unusual impact fund. We only invested in voluntary and compliance credits. And today, there is a host of impact funds that are popping up almost every single day. And that's good news because they're mobilizing capital and they're looking for investment opportunities. The other thing that's a bright spot is, yes, climate finance flows have doubled from the 2019-2020 period to the 2021-22 period. We've reached about $1.3, $1.4 trillion in climate finance. So yes, we are witnessing increased flows, not enough, but we're on the upswing, which is really great. And then I'll close this question with saying it's gratifying to see the level of international cooperation. We're seeing all sorts of consortiums, associations, collaborations The first one was the Glasgow Climate Pact, which was the one that sort of said developed countries are going to promise $100 billion annually to developed countries. This is morphed into all sorts of other efforts. The Green Climate Fund, as you know, under the United Nations FCCC, the rise of sovereign green bonds. So this is where countries are actually issuing their own green bonds to finance climate-related opportunities in their own country: energy efficiency, sustainable transportation, renewable energy, and natural system protection. And then we see a host of adaptation funds emerging, and we also see carbon trading initiatives. The well-known one is the European Union Emission Trading Scheme, and then the cap and trade system in California. So we see there is movement. There are bright spots. It's definitely not a doom and gloom scenario. The challenge is it's simply not at the pace and scale that we need.
Absolutely. And as you said earlier, we've crossed the trillion mark, but we're still about 7 trillion off annually in natural solutions alone. So of course we have a long way to go, but there is optimism in the sense that we've finally passed the trillion. And then to your earlier point about subsidies and loans and bonds going towards oil and gas versus, green energy, for example, we've crossed the threshold where more from a bond standpoint is going towards renewable energies versus oil and gas. So there are some bright spots. There definitely are. So I would like to change directions a little bit to what you just touched upon at the very end, carbon markets, which is also one of our areas of expertise at Gordian. Of course, that's a tale of two markets. There's the voluntary and then there's the compliance. First, we're going to start with voluntary and then we'll work our way into compliance. Every year, the ecosystem marketplace puts out an annual report that basically does a summary of the whole entire market the year prior. So they just released their 2024, which was taking a look at 2023. The 2024 report showed that the voluntary carbon market actually contracted big time, down from around nearly 2 billion in 2022 to around 750 million in 2023. So the overall market value contracted very largely. And then the credit prices are also depressed. What is your take on this?
My sort of high level take on this is the evidence of growing pains of a market. The analogy I would bring is we can all think about the emergence of the internet era. There was all sorts of promises. Everybody was going to be billionaires. And, the whole market, as you know, crashed in the dot-com bust. But today, no one can dispute that the internet is an incredible machine for delivering value, creating wealth, and education. And so for the voluntary carbon market, which I've been involved in for 2 decades now, this contraction is not favorable, but it's par for the course. I can tell you, of course, what it's related to. We had a spate of negative media that really called into question the integrity of carbon credits, who was hustling or creating vaporware. And some of these stories had some credibility. I mean, we can't pretend that everything's great in a market. It never is in a nascent and emerging market because you have all sorts of market actors who have different agendas. And so the media called out some concerns, which I think the market responded to and is responding to in a favorable way. Of course, the biggest beacon on the horizon on the supply side is the Integrity Council for the Voluntary Carbon Market, where ICBCM is seeking to raise the international threshold for what defines quality and integrity for carbon credits. And then on the demand side, we have VCMI, the Voluntary Carbon Market Initiative. And so this sort of tightening up across the market is very much what's being needed. So in a sense, there's a good outcome of this contraction, which is great. I think the flip side of that, which is not so great, and we've seen this with clients that we work with, is it is unfortunate that corporates that are taking a stand, taking action by both internally mitigating their own scope 1, 2, and 3 emissions and engaging in the voluntary carbon market are being chastised. And this is leading to this concept of greenhushing, where it's sad that companies that do nothing get very little media scrutiny, and those that are doing something are taken to task. And that's a real problem, especially when you examine the data. So there was a number of reports that examined the performance of around, I think it was 5,000 companies. And the data was pretty clear that those that engaged in the voluntary carbon market were 1.8 times more likely to decarbonize every year and 1.3 times more likely to engage in supplier engagement strategies. So actually engaging in their own supply chain to reduce the emissions profile. 3.4, 3.5 times, I forget the exact ratio, to adopt a science-based climate target, and 1.2 times more likely to have board oversight. So these companies that are doing something are showing and proving that by virtue of engaging in the voluntary carbon market, they're actually way ahead of their peers that are doing zero. And so I think that's a very important takeaway, that despite the contraction, the evidence, this is research, this is not conjecture, is that these companies that are choosing to take action today, last year, and next year are doing a heck of a lot better than the companies that are sitting on the sidelines.
Yeah, I couldn't agree more with you. They're definitely receiving a lot of the negative press, although, as you had just pointed out in many different statistics, that they're the ones that are kind of leading the charge. So it is unfortunate to see that. At the same time, what we're seeing is there are some companies that are falling out of the activity, but it does also feel like a good amount of companies are staying the course or readjusting. And so, again, there's some optimism there that it's not completely sidelining everybody. And of course, it depends on the sophistication of the company. But you yourself were an advisor for the ICVCM. And so you put in a lot of legwork at the very beginning, I think almost 2 years, to help get CCPs and everything kind of on track. And ICVCM has approved a handful of standards, and I think about 7 or 8 different methodologies, with more methodologies that will get their CCP approval coming. We imagine more announcements on the way, definitely more before the end of the year. And so how do you see the CCP label for both the standards and the methodologies impacting the market?
Yeah, it's a good question. So years ago, I used to have a glass recycling company. We had operations in South Africa, where I'm from, and Europe and the US. And I was engaged in a European initiative, which is called Groene Punt, the Green Point. And it was to try and establish protocols or unified standards by which we could inform consumers what was recycled and what we meant by that. Because in the early days, in the recycling industry anyway, you didn't know if it was 100% post-consumer waste or if it meant that the product that you were buying could be recycled but wasn't necessarily recycled, and so on. And that standardization in the recycling industry, which we now see as a ubiquitous standard, pick up anything and on the back it will tell you very clearly, went a very long way to delivering comfort, certainty, trust that what you were buying actually had that degree of recyclability or had come from recycled materials, in a very similar way to the early struggles in the organic industry. There were all sorts of organic standards. Nobody really knew what it meant. And today, when we pick up a USDA organic avocado, it's got the decal on the avocado, we don't need to go and visit the avocado farm. We don't need to see what the planting practices or the irrigation practices or harvesting practices. We have full faith and confidence in the fact that that organic avocado is organic. And that propelled the organic movement. So to answer your question, the work of ICVCM is critical because it's bringing a standard or a seal of trust in terms of the core carbon principle, the CCP approved label that will be attached to credits that are issued from eligible programs and approved categories or methodologies. And it will massively advance the adoption of carbon credits as a transition tool because corporates don't have to second guess. Buyers can just trust the fact that the work has been done, the diligence has been done, and that they can safely buy these. And if you look at the makeup of the 10 core carbon principles, they span the gamut of incredibly important things that cover transition to net zero, benefit sharing, sustainable safeguards, integrity, no double counting, additionality, all the things that have plagued the confidence in the voluntary carbon market are being really robustly addressed by, I believe, by ICVCM and the introduction of CCP labels. And so to answer your question, I think there's going to be a massive positive impact. It's a huge undertaking that the ICVCM has taken on to bring this seal of approval. But as you noted, I spent 2 years working with a team there, and the level of diligence and care and thought that they put into balancing rigid or strict requirements on integrity with market realities is nothing short of admirable.
Without a doubt, there's been a ton of work that's gone in, and I do think that you're right that we're going to, in the coming months, see the fruits really, really blossom as we get more clarity and more methodologies or categories, as you said, start to get this approval. So I agree with you. I think that like all of this work that's gone in from dozens and dozens of people all across the globe working to raise the integrity here is we're going to see the positive impacts. I'm very optimistic about that as well. I wanted to ask another question, like before we switch out of compliance carbon markets, and it's related to, it's tied back to what we were talking about earlier, which is companies that are committing to decarbonization. And so this is specifically about SBTI, or the Science Based Targets Initiative, which many refer to as the gold standard of decarbonization plans by corporations. And I think last time I checked, there's something like over 8,000 companies that have either committed to a net zero plan or plan on committing to a net zero plan via SBTI. We are both familiar that earlier this year, SBTI announced that they may allow companies to use carbon credits to offset their Scope 3 emissions. Now, this created a massive shakeup. We don't need to talk about the shakeup. What I want to talk about is your thoughts about the idea of allowing companies to use credits to offset Scope 3, because as we know, Scope 3 is generally the biggest emissions from a company. They're also the most difficult emissions to reduce. And so it would be good to hear your thoughts on this idea of potentially allowing companies to use this to address Scope 3 and their hard to abate emissions via the use of carbon credits.
Yes. Well, first of all, I think it's really important to frame what the purpose of a carbon credit actually is. And this is not a unique perspective from us at Gordian Knot Strategies, but it is a transition tool. That's what it is. It is a bridge to allow entities, governments, corporations enough time and technological development to implement things that will get us to the net zero targets that we want in a economic viable way. It is not meant to be a global band-aid for all climate mitigation targets. That's not the point of it. So coming back to your question, if a company is able to use carbon credits to offset their Scope 3, what that means is that they have the ability to apply a carbon credit and use it as an offset in their specific value chain. Now think about that. What we're all wanting to do is have companies to be incredibly responsible. And many, many are. We've got leaders all around the globe. But the ability to incentivize companies and allow them to use credits in this fashion, which directly address their value chain, is incredible. And it would do an immense amount of good. Now, the caveat, of course, is that it's for those hard to abate residual emissions throughout. That's a very clear thing. And we also recognize that it's a transition tool. We've just given the specs of how companies that engage in the voluntary carbon market are much more active in their decarbonization strategies. So the logic will apply the same here, which is if SBTI allowed the use of credits for offsets to meet Scope 3 targets, these companies, by virtue of their engagement, will just move a lot faster, a lot more vigorously and diligently towards their net zero target. So to me, there is so much to gain out of this. It's sort of indisputable to me. I think the challenge, of course, is that the question as to whether they should or they shouldn't is being mired by the overarching conversation, which is, should we use carbon credits or not? And the media, has not done us all too many favors in that regard by their attempt to deliver a balanced perspective, i.e. publicizing critics and positive proponents' view as if they're equal, is problematic. But if we accept, for example, that ICVCM does deliver CCP-approved credits that meet the integrity bar, that meet that bar, and avoid or mitigate all of the criticisms as far as possible. It cannot be perfect. This is ICVCM's first iteration. They plan to do an iteration every several years. But the point is that if we can frame those credits for offset usage in a high quality way, then SBTI should absolutely allow that in the Scope 3 target context. Again, for everything that is beyond the ability to mitigate within Scope 3. So hopefully that's an answer to that question.
Yeah, absolutely. And I think that you nailed it. When you look at what ICVCM is doing, and then in context with SBTI, they're two parts of a bigger puzzle. And if done correctly, they complement each other. And I think that that's absolutely possible.
Sorry, one other point I want to make, and if we talk about compliance markets, this will make a lot of sense. But when you think about the California cap and trade system, which to me is a remarkable system, it covers 85% of the greenhouse gas emissions in the state. And it's a combination of regulation, a decreasing cap over time, but also allows those corporations to use California carbon offset CCOs under a strict utilization limit, which is at 4% now. It'll improve to 6% in 2026. But the point is that what the cap and trade system did right was they allowed the flexibility for entities to reach their targets while the cap was declining. And this has been incredibly powerful because despite all the early criticism about companies gaming the system or utilizing California carbon offsets indiscriminately, it's actually worked incredibly well. And so in a very similar way, in the voluntary carbon market, we need to allow these corporations the flexibility to meet their targets as we face a tightening climate target. If we stick to the 1.5 degrees under the Paris Agreement, then we will continue to see the increased stringency around improved greenhouse gas emission efforts. Now, what's lacking, of course, globally, which we try and do under the Paris Agreement, is declining cap that California has. And if countries around the world unanimously and seriously stuck to their plans under their nationally determined contributions under the Paris Agreement, then we would have essentially a declining cap. We would globally recognize we need to reduce. And while we do that, we have the ability, the flexibility to use high integrity credits as a transition tool to help us along the way.
I think that that would be a great next step for the voluntary carbon market to kind of mirror what the compliance markets are doing with that cap that reduces over time. I think that could be VCM version 4 or whatever version we're in now. I hear people say we're in VCM 2.0, 3.0, but I maybe the next one, because you're absolutely right. And you kind of teed us up for the next part, the conversation, which is about the compliance markets, and use California, which I think is a brilliant example. Now, if you look across the globe, there are, I think, something like almost 53 different national jurisdictions that are covered by a compliance market, whether that's cap and trade or whether that's like a carbon tax. And then you have subnational jurisdictions such as California or RGGI in the East Coast of the US. And then you have a bunch of countries that are exploring and developing compliance carbon markets. And then, as you said, in California, it's actually working. And if you look into the markets around the world, they do also seem to be working by reducing the greenhouse gas emissions of the covered sectors, which is oftentimes the energy sector and then a handful of others. And then simultaneously, they're funneling that money back into green projects. So if you uncover what's happening in Europe, billions of dollars being generated from the EU ETS is then going back to other decarbonization activities, such as building renewable energies in parts of Eastern Europe. It's actually working. And so this is a big kind of overarching question, but give me your general thoughts on compliance markets and their effectiveness.
Yeah, I mean, I'm a fan. Well, first of all, I'm a fan of market mechanisms. Like any market mechanism, whether it's the trading of cocoa or aluminium, stocks, equity bonds, whatever, they thrive, but there are bookends of regulatory support, regulatory incentives. And so while I'm a fan of market mechanisms, I see the utility of having enabling regulatory conditions. And the California cap and trade system is a beautiful example of that, where they've set up the structure from a regulatory point of view, set very strict decreasing cap targets, and then they allow the flexibility of these entities to meet that, whether it's through the trading of the carbon allowances that they procure via the auctions or by using the California carbon offsets under their utilization limits. So the ambition of, if I just talk about California as an example, so their target is 40% reductions by 2030 below 1990 levels. So it's pretty significant. And to date, the auctions of these allowances that the covered entities are able to use to meet their targets has generated about 27 or $28 billion since the program began in 2012. And all that capital is managed by the Greenhouse Gas Reduction Fund. And that fund deploys the capital into other projects that are also supporting climate mitigation, reducing emissions, improving public health, improving the biodiversity, and really helping disadvantaged communities that are suffering within the state. So tremendous amounts of capital are going to these entities by virtue of the carbon market. I think this focus on equity has been very, very powerful. Now, it's not to say that it hasn't been without bumps. The California Air Resources Board that manages the program has had to do lots of tweaks and modifications and reissuances. But overall, the focus on equity, ensuring that these vulnerable and disadvantaged communities get the support in adapting to climate as a change, has been very, very strong. As I mentioned, the flexibility is huge. It allows and encourages these businesses to find what makes sense to them, what's cost effective in terms of reducing their emissions in line with the cap. And then the other thing we shouldn't lose sight of is, and this is often the argument I often see in conferences and seminars and panels that I participate in, is we sort of get myopically focused on the voluntary carbon market or the California emissions trading scheme. But remember, these pieces are just part of a broader puzzle. In California, there is a broad suite of climate policies. The Renewable Portfolio Standard is one. The Clean Fuels Program is another. Energy efficiency. So, everyone focuses on the cap and trade as if it's the end-all and be-all to the state solution. But it's not. Similar to the European Union ETS. The voluntary carbon market, if we take that analogy further, it's just one part of the solution. There's all sorts of things around improving climate disclosures, the ESG movement, impact investing, voluntary carbon markets, blended finance. So, we get stuck on the ins and outs of the particular carbon mechanism. But remember, it's just part of a larger puzzle.
Absolutely. And I think that another point that you touched upon, which is also extremely important for people to understand, is that, yes, the current version of any of these markets is not the final version of these markets, right? They're growing, they're changing. California, as you said, is a great example of reevaluating. They have public consultations. And so it seems oftentimes that people in our space get too stuck up on how does the market look like today? What are all its faults? Under the assumption that it's not going to change or improve or adapt. And that's simply not the case. Markets definitely do over time with like new regulations and modifications. And so I think it's also important for us to always keep that simple fact in mind, is that what we see today isn't necessarily what it's going to be in a year. Changes are going to be made, and they're going to be responsive to whatever's happened inside of the market over the last X amount of months.
Can I just add? I just want to add one thing. I had dinner with somebody the other day that he opened up his crypto wallet and showed me that he had about $850,000 in Bitcoin. And so we got talking about crypto markets, and the analogy is very real. Leading up to the crypto crash in 2018, everybody was really gung-ho and involved in the market, and Bitcoin was at $21,000 or $20,000. And by the end of the year, it was 3,000.
Exactly.
Okay. But today, the crypto market, just like the voluntary carbon market, has experienced kind of a reset, a revision, a 2.0, however you want to explain it. And the appetite for Bitcoin has not flagged at all. It's continued despite all the Netflix documentaries on the crypto collapse and so on. Now, I'm not a fan. I don't actually invest in crypto myself, so I'm not advocating it in that sense. I'm just saying, like any emerging industry, whether it's the internet era, the crypto market, the voluntary carbon market, these are all growing pains.
Yeah, I appreciate that. That's absolutely correct. So, Sean, for the last topic I want to talk about is impact investing, which is one of our specialties. you're super, super fluent in this space. And so I want to spend a little bit of time talking about here. And so earlier we talked about the need for private capital to help with reaching our global climate goals. Where do you see impact investing fit into this, or how?
Yeah, well, let's frame up impact investing first. So I like the framework that the Impact Investing Institute developed. It's a very clear graphic. So on the far left of their graphic, you've got traditional investing. And traditional investing is you're investing for what they term finance first. You're looking for financial returns. End of story. The next over, as you move in the spectrum, so I'm going to go from left to right, left being traditional and the far right being philanthropy or concessionary capital. Okay, so next point over from traditional, you get responsible investing, which now starts to consider what we call impacts. And when we talk about impacts, what we mean here are environmental impacts or social impacts, but things that are beyond just the fiscal returns. And then the next step over as we move along the spectrum is sustainable investing, which now starts to contemplate this balancing or consideration of finance and impact in its approach. But it's only really when you get to the next step, which is impact investing, where that consideration between fiscal returns and impact returns are balanced. That's the role of the impact investor. It is to ensure that they can achieve higher than modest market-based returns along with credible, measurable impact. And of course, on the far right, you've got philanthropy that has no interest in financial returns, and they're all about impact. And so that's sort of the spectrum and where impact investing fits in.
What's driving the growth in the field of impact investing?
Yeah, good question. Well, a couple of things. I think we've seen a lot of activity around the increased awareness on social and environmental issues. This has really led to all sorts of environmental, social, and governance framework and criteria for companies. And so when companies adopt these ESG practices, the impact investment community looks to see, is there a way that we can essentially profit both from impact and financial returns? This has been bolstered by the fact that companies that do adopt ESG practices have been shown to be actually more resilient and lead to better long-term financial performance than those that don't. So again, evidence shows that ESG embracing firms actually perform better in the long term. The other driver is the millennials or the younger generations. They're demanding more sustainable and responsible investment options. Absolutely. I mean, when I was with the team at the Climate Trust, I remember very clearly having our 401k advisor into the office and our team saying, give us the green options for our 401k. This is happening across the world. Of course, while I called for more policy and regulatory support or incentives earlier, there is positive traction here, which is encouraging sustainable finance, which is great. And then the other thing that's driving it is the proliferation of impact measurement frameworks. Even though we don't have the standardization yet, we see a lot of these frameworks coming to the fore. And then we're also seeing a growing body of evidence that suggests that impact investing can actually deliver competitive financial returns. This is massive. There's this notion out there that even though impact investing is positioning fiscal and environmental impact as a balanced approach, there is this sentiment out there that actually impact investing is sort of a loss leader. And that's not actually the truth. There are mountains of case studies where people are investing capital, and many of them we help, as you know, which are enjoying both the financial return and credible, measured impact. So I think that's really attracting a lot more impact capital to the sector. And then lastly, we see the emergence of collaborations around the world. So I'm gratified to see sort of Main Street organizations who either collaborate or acquire the environmental consulting group or the impact investing fund. These mergers, these partnerships are increasing around the world, and that makes noise and attracts impact investors. We, as you well know, get calls from mainstream investors from Europe or America or in the African context who are wanting to say, how do we go about exploring impact investing? Because we hear about it, but we really don't know how to navigate it. So these are all drivers, thankfully.
Thankfully, indeed. What would you say impedes the scaling up of impact investing, and what do you think needs to happen to accelerate efforts here?
Yeah, I mean, this is my favorite song, right? To me, the number one thing is risk mitigation. If you track the growth, which I won't go into detail, but if you track the growth of renewable energy, which stemmed sort of in the oil crisis in the US in the 70s, when you look at how that industry proliferated, despite all the critique against it, it had all sorts of government incentives, the benefit of government research, the introductions of loan guarantees, all sorts of credit enhancement, risk mitigation instruments were brought to bear that really helped that industry. When we look at impact investing, which includes, investing in the voluntary carbon market or projects and so on, what we really have a void of is real mitigation instruments. It's not to say it doesn't happen, but those efforts are disparate, disconnected, too small a scale, and too slow. They're too bespoke, essentially. And so, for me, the ability to create risk enhancement, credit enhancement mechanisms that are ambitious and significant in scale is what we need. In addition, we need standardization. We need frameworks to assess these impact investing opportunities, to measure them, to report them. And without these standardized frameworks and metrics for measuring and assessing these opportunities, it's an unsolved jigsaw. That's what we've got. Everyone's trying to make sense of it all. And so if we can develop these globally accepted standards, these tools for assessing projects, I mean, as you know, some of our work is heavily involved in effectively screening for climate investment winners using a framework that we use. But it's not global, it's not standardized, it's not interoperable. And so those are the types of things that we need to move impact investing forward.
All right. So my last topic for you is one that we've actually had a few conversations about this year. We're starting to see pop up a little bit more. There's definitely movement, I think, on global conversations about this. And it's about biodiversity crediting. If that field or somebody in that field were to come to Sean Penrith and ask for advice, what would you say to them?
Yeah, I agree with you. It's remarkable to see how much media play biodiversity crediting is getting. And just for context, and you know this, but when I was sort of in the early days living in Portland, Oregon, I was part of a group of people where we established the Ecosystem Services Council. In fact, we got the governor of Oregon to sanction it. Unfortunately, we had no authority and no budget, but it didn't go anywhere. But the attempt there, which I think we were on the right track, which is the advice I give to the biodiversity movement, is we recognized early on that we needed the equivalent of the US Green Building Council that almost single-handedly moved high-performance buildings into the mainstream across America. I mean, they did a phenomenal job. And so what we wanted to do for the Ecosystem Services Council was to create the standards, the assessments, the threshold, the reporting, all of the framework infrastructure that would support biodiversity, species, water, the full suite of ecosystem service credit. So my advice to the biodiversity contingent is really to follow essentially what ICBCM has done. If you think about ICBCM, they're a quasi-regulatory body. They were born out of the Task Force for Scaling Financial Disclosures, but they were largely self-appointed, which initially met with large derision. But now people are seeing the value and the utility of ICBCM. And similarly for biodiversity, the quicker that contingent can establish the framework, the modalities, the way that we would assess for additionality and permanence, all the challenges. This is the advantage the biodiversity industry has. They can look at all the travails of the VCM, the voluntary carbon market, and say, okay, how do we head this off right now? How do we avoid the proliferation of multiple standards that have no harmonious interplay? How do we mitigate this argument that a biodiversity action is not permanent? How do we argue that it would not have occurred or would have occurred anyway, thereby undermining the additionality argument? So to me, the advice that I give folks that I speak to, and I was just speaking to somebody in London at the FIS conference about this very thing, is to map every stumble that the voluntary carbon market has taken and then figure out a mitigation mechanism. One. Two, create a global biodiversity council. And there are efforts. I'm not saying there aren't. There's all sorts of biodiversity associations and so on. But we haven't got the critical momentum where everybody gravitates to this is the standard, which is what ICBCM is attempting and is doing for the voluntary carbon market on the supply side. That's what we need in biodiversity.
As you were explaining all of that, Sean, I was thinking to myself, we without a doubt need to make this topic one of our take deep investigations that go out in our monthly newsletter, Virtus. Like without a doubt, what you just explained should for sure be something that we write about and put out in our newsletter, because I think that would be an excellent our take article.
Yeah, absolutely.
Okay, Sean, so we're going to close it out. You and I came up with this idea a year ago when we were building out Untangling Climate Finance. So I have to close out the same way with you as I would any other guest. And this comes from our both shared interest in Stoicism. Epictetus once said, "What concerns me is not the way things are, but the way people think things are." Sean Penrith, what do you think is one thing that must be done to change the way people think about climate finance?
I knew this question was coming. Yeah, I think we, and this term has been used almost to excess, but it's relevant, and that is the need for holistic thinking. And what I mean by that is, it is absolutely critical that we align all of our financial endeavors, efforts, tools, instruments with these principles of sustainability, prudence, the advancement of the common good, essentially, rather than what we see, the short-term gains and the self-interest in essentially a financially driven world. And so if we can change the way people value, that's the important thing that we have to change. And it's a massive one. If we can change the way people value essentially what is naturally gifted to us as citizens of this planet, then we can change the way we direct climate.
Brilliant. Couldn't agree more. That was excellent. Okay, Sean. Well, this was good. As always, extremely insightful. We could have gone on for probably another hour with each of these different subjects, but in the essence of time, we should wrap it up. And so expect for us to do one more of these in either 6 months' time or a year's time. I'm going to be barking up your tree to have this exact same conversation where we look at all of these topics again and see what movement's happening, because as we know, things are happening so quick and we need to be discussing them. So your insights, your brilliance is always appreciated. And I know that our audience is going to love this episode. So thank you for taking an hour out of your day. I appreciate it, Sean.
Too kind. Thank you. Thanks, Jay.
All right. That's it for today's episode. Huge kudos and thanks to Sean for the engaging conversation. And in the spirit of our talk about impact investing, I wanted to take a moment to shout our proprietary impact investing tool, Traro. Traro was developed to screen and help identify winning climate investment opportunities by assessing projects against our own internal framework. If you'd like to hear more about Traro, please reach out to us. And if you'd like to discuss any of the topics covered in this episode, such as climate finance, carbon markets, biodiversity credits, and of course, impact investing, then you can email me directly at jtipton@gordianknotstrategies.com. My email address is in the show notes. And before you exit out, I kindly ask that you take a moment and please subscribe and leave us a review on Spotify or Apple Podcasts. If you're on Spotify, don't forget to hit the little bell to get notified about new episodes, because we offer more podcast content than just Untangling Climate Finance. You can hear our weekly audio episodes from our written newsletter, Sliced, for quick and insightful essays on our work. All right, catch you next month. This podcast is produced by Gordian Knot Strategies.